Hello, my name is Chef Colin Roach, and today we're going to be talking about the income statement. In this video, I'm going to break down the income statement so that it is wicked easy to understand. And I'm going to do it with these objectives in mind. I'm going to tell you the purpose of an income statement, the components of an income statement. Then I want to define, explain, and show you how to calculate sales and cost of sales. And then we're going to move down into the bottom half of the income statement. We're going to talk about expenses, net profit, costs. So let's get started on that. So the first thing we need to do is say, what is an income statement? What is its purpose? What is it designed for? Well, it's to provide information to management about the financial performance of the restaurant over a given period of time. Now, this is true with any business. Income statements are used in it, but I'm going to specifically talk about hospitality business, food service business, and I'll use those as my examples. Now, it's also referred to, as you see here on the screen, as the profit and loss statement. And it lists the income and expenses that a food service operation is actually incurred during that given time period, which is usually monthly, definitely yearly, but it could be done even sooner, like weekly, if someone really wanted to know. The statement will say at the top for the month ending or for the year ending. So that'll give you an indicator of what those financials, those numbers, those calculations represent, what time period. So in other words, it's a tool that's going to provide management with an actual summary of how well a business is doing and can be then used to help forecast future sales, expenses, and profit. So here, as you can see on the screen here, the income statement consists of 4 basic parts or sections, which I want to review in these next few slides. But you'll see these parts, and then let me see if I can highlight them here. I'll use red color, is the sales. Let's make that a little thicker. And then we have cost of sales. So whatever it costs to bring in this revenue right here, is we had to spend $92,000 to make that $284,000. So that's our food and beverage cost. And then we subtract those, and that gives us our gross profit. And from that, we go to the bottom half of the income statement, which is our operating expenses. And we'll talk about how you can divide those up into controllable and non-controllable. And then finally, or hopefully, we've got some kind of profit at the end of that. So that's what we're going to kind of talk about. So let's get started on that. So part 1 is the sales. And this is a term used for revenue that is generated, in the case of restaurants, by selling food and beverage. And by selling them, well, it's those sales that we get from those items. It is the money the customers pay the restaurant for the goods and services it provides. It's also the total dollar amount that the restaurant then has to pay as expenses and hopefully generate a profit from. So let's take a look at this again. Sales. Food service operation usually tracks 2 types of sales. We've got food sales, and we also have beverage sales. And they're separate categories in order to see where the revenue is specifically derived from. So we don't want to just lump it together, which we will have, our total sales. We want to break it out. How much of those total sales were from food, and how much of those total sales was from beverage. And then we add those together, and we're going to get our total sale. When we add these food sales and beverage sales, we get total sales, which is also known as gross sales. Now, of course, you could have other types of sales as well. Like a restaurant may sell merchandise. Maybe they're selling t-shirts and mugs with their name on them, glasses, cups, something along that way. Maybe you're selling gift certificates. You want to separate that out. And there's lots of ways that it could be done, but for our purposes today, we're just going to focus on food and beverage sale. Now, business will often determine the percentage of sales represented by each of these types of revenue collected as a way of comparing numbers. It's if someone just says, well, my beverage sales were $300,000, it doesn't really tell you anything unless you know the total sales as well. But if they tell it to you in a percentage, that definitely helps. So to determine the percent of each type of sale, which is 70% for food sales, we would take $700,000 for the food sales and then we would divide it by our total sales, which is $1 million in this case, which tells us that food represents 70% of our total sales. Now, we could easily know that total sales is 100%. That would give us 30% for beverage, but we could always figure that out as well by using 300,000 divided by the 100,000. So those are our formulas. Beverage sales by total sales is beverage sales percent. Food sales divided by total sales is food sales percentage. And total sales is always 100%, because without sales, we don't really have a business. So we always base it off of sales. So now that's how much we brought in, $1 million, but we had to spend some money to buy that food so that we could then prepare it and sell it. We had to use some money to buy the beverages that we then sold to bring in these sales. And that is what the second part, or part two, which is what we call the cost of sales. The total dollar amount the restaurant spent to purchase the food and beverages that were then used to produce those sales. The total dollar amount is only from buying the food and beverages that were used to produce the sales, not what is left over. It's still in inventory, which can be sold in the future. So it's only what we use to bring in those sales dollars. Again, we only count the amount that was used. Anything left over stays in inventory and is not included until it is used. So cost of food sales, or food cost, is the total dollar amount spent to purchase food and beverage items, like alcohol, that is needed to produce those food sales. Okay? And beverage sales, or cost of beverage sales, is the total dollar amount spent to purchase alcoholic beverage items, non-alcoholic beverage items, and food items that were needed to produce those beverage sales. So they give me an example. Regarding beverage sales, if we use cherries or limes in our drink, even though they're a food item, they would go under cost of beverage sales because they were used to produce those revenues. Just like cost of food sales. If we had to put wine in a sauce, even though it may be a beverage, it goes under food cost because it was used to produce those food sales. And cost of goods sold, which is what these two are often referred to as COGS, cost of goods sold. So the beverage and the food are COGS. So you can see these definitions here on the screen. Cost of food sales, which is our food cost, is the total dollar amount spent to purchase food and beverage items that were needed to produce food sales. A cost of beverage sales, or beverage cost, is the total dollar amount spent to purchase alcoholic beverage items, non-alcoholic beverage items, and any food items needed to produce those beverage sales. For example, celery sticks that may be in a Bloody Mary. Okay, that goes under beverage cost because it was used to bring in those beverage sales. So the actual food cost is determined by calculating the cost of food sales, which involves taking a periodic food inventory, because we need to know what was left over. So there's a formula for that. At the beginning of the month, they would add up everything, and then they would add in their purchases, and then they would subtract their ending inventory. So let's take a look at an example here. Sally and Susan own a restaurant that we'll call Sisters. And the food inventory on May 1st was $13,250. During the whole month of May, they purchased another $126,000 worth of food items. But all of that may not have been used to produce those sales, so they have to find out what was left over. So at the end of May, which would be the ending inventory, which also is the opening inventory for June, was $14,325. What was their cost of food sold in May? So you can pause that if you want to try to figure that out real quick. If not, just let it keep running, because here we go. The formula for this, as mentioned, beginning inventory plus purchases minus ending inventory gives you the cost of food consumed. So you can see we had $13,250, which was our food inventory on May 1st, or our opening inventory. And we had $126,000 of purchased food items during the month, so we add those together. And then we got to subtract what was left over at the end of May, which became our June 1st opening inventory. That was $14,325. That tells us, doing those calculations, that our May inventory and our June inventory and our purchases all coming together there is $124,925. So in other words, the cost of food and beverage used to produce sales is derived by taking that periodic inventory at the beginning of the month, tracking and adding in all of the costs of food and beverage purchased during the month, and then taking a periodic inventory at the end of the month and subtracting that amount. So it's easy to remember. Beginning inventory plus purchases minus ending inventory gives you the cost of food and beverage consumed. So let's look at these cost of sales percentages now. As I mentioned, we like to talk in percentages. So because raw dollar figures for costs are of no real significance for control purposes. Now again, if someone just told you I had $10,000 in costs or sales, it doesn't mean anything unless we have all of the information. So therefore, we must express them in a relation to a figure which may vary. So this is referred to the cost of sales percent, or sometimes cost to sales ratio. In other words, all costs should be shown as a percentage of sales. For example, here are the food costs and beverage costs kind of formulas. So you see cost of food sales, food cost dollars divided by our food sales dollars multiplied by 100. And cost of beverage, as I mentioned, same thing, beverage costs dollars divided by beverage sales dollars times 100 gives us our beverage costs. So we had 231,000 food cost dollars, but it cost us to bring in that $700,000 in food revenue, and that would be 0.33 multiplied by 100 makes it a percentage of 33% food cost. Beverage cost was 63,000 from our example that we had to purchase to bring in those $300,000 in beverage sales. Multiplied by 100 tells us our beverage cost for that month was 21%. So analyzing these cost ratios, right, managers can now easily target problem areas, which they can investigate and change to kind of maximize their profits. Because if your food cost budget is 30% and you're showing a 33 now, something's going on there. Same with your beverage costs. So let's look at cost of sales. So we talked about in our example, we had food sales of 700 and beverage sales of 300 for $1 million in total sales. There's our percentages. We divide the 700 by 1 million or the 300 by 1 million to get those percentages. So our total sales is broken down. We make about 70% of our business from food and 30% from beverage. Regarding the cost of sales, you can see it there as 231,000 to bring in that 700 and the 63 to bring in the 300 in beverage sales. So to find that out, we take our 231 divide by 700 or our 63 divided by 300. So right now we know our food cost is 33% and our beverage costs are 21% for a total of 29.4. Okay, so now we have our sales and we have our cost of sales. If we subtract those two, take that million and subtract 294 from it, we would get what we call our gross profit. Gross profit is the amount of revenue that's left over after determining how much it costs to purchase the food and beverage needed to produce those sales. So it's the amount of revenue that remains after calculating the dollars spent to purchase food and beverage items. So by calculating this gross profit, a business then knows how much money is available to then pay our operating expenses. So in other words, gross profit is the amount of money left after subtracting the total cost of sales from total sales. So right now we have a gross profit of $706,000. And this kind of serves as a guide in estimating if there's going to be adequate money to make a net profit. So calculating the gross profit, to see it here on the screen, gross profit, as mentioned, is the amount of money left after subtracting the total cost of sales from total sales. So you can see that there. 1 million subtract 294 gives us $706,000 for a 70.6%. So gross profit serves again as a guide in estimating if there's adequate money to make a net profit. The greater the gross profit margin, the better the chances of generating a net profit. And this section would be considered, as it says up there, the top half of the income statement. Okay, that's the top half. So now we can move down into the bottom half of the income statement. Operating expenses in the bottom half of the income statement consist of all labor and overhead costs. Labor costs is the total dollar amount spent to pay employee wages, their salaries, their benefits, and their payroll taxes. Overhead is the combined cost of all other expenses that a business incurs, excluding food, beverage, and labor. Some examples of overhead costs would be linen, glassware, equipment, occupancy costs like rent or mortgage, utilities, advertising. All of those would be considered overhead. Now, again, this is some different line items here. You can see salaries and wages with $250,000, benefits, direct operating. These are called line items, and they would vary by every business. For example, you see this one has music and entertainment there for $11,000 they're spending. You might not have music, so you wouldn't have that, but you may have something else, delivery costs or something else in there. So these can change, but the expense percentages, as you'll see over there, tells you how much of those dollars representing from sales. And how you get that, you'll see down there at the bottom, down there, individual expense amount. So let's take salaries and wages. That's $250,000 divided by total sales. Remember, our total sales was $1 million. Tells us that salaries and wages represent 25% of our money that we need to use for that expense. That's a big chunk, which is about right. And then you add in the benefits and payroll, you're getting up there at 30, 35% for labor costs. So everything else has a percentage. And our total operating expenses, if we add them all up, $642,000 there at the bottom, represents 64.24%. Now down here, we have kind of a unique thing called depreciation. You may not have heard of that before. But depreciation, as I'll explain here on this next screen, is the process of writing off against expenses the cost of an asset over the useful life of that asset or that piece of equipment. So if you buy an oven for $10,000 and you don't want to write it off in 1 year because it's still good. So that life expectancy of the oven may be 10 years. So every year you would write off $1,000. Plus writing off all $10,000 1 year is going to change your net profit. Probably would give you a loss. But then the next year's, it's going to show you have more money than really that oven should have eaten up. So it's spreading it out. So it says there, as the value of equipment begins to diminish, an operator can depreciate the value of the equipment until it has no value or a salvage value. So the amount is meant to be cash that's set aside to replace that equipment. And it's strictly for tax purposes. So every $1,000 you get to write it off. So your bottom line is a little smaller. You don't have to pay tax. And hopefully you're saving that $1,000 until after 10 years, you'd have $10,000 you didn't have to pay tax on. Now you can replace that oven because that oven is an expense. It was used to bring in those sales, right? You had to cook the product maybe with it. And one of the things with depreciation is land cannot be depreciated. It's land, really, real estate appreciates. That's one of the only things they don't let you depreciate. But everything else, your delivery vehicles, your equipment, all of those things have a life expectancy. And since you have to buy them, they're a business expense, you can then write them off. Let's pause here and take a quick little review break. Cost of sales is food plus beverage costs, and operating expenses is labor plus overhead. Okay, so those are the two of our categories there. All right, now let's go into part 4, calculating the net profit. We've got our sales, we've got our cost of sales, we've got our expenses. So now we can take expenses, our total, and subtract it from our gross profit, and that will give us our net profit. So, and it's the amount of revenue left after paying costs or expenses. This is before taxes. This is what our taxes is based off of, our net profit, the bottom line, because the bottom line in the document, right? So that's your net profit, and that's what you're going to pay taxes on. So gross profit in our case was $706,000 for our example. Our operating expenses was $642,400. We subtract those. It left us with a net profit of $63,600 or 6.36%. You can see here, net profit divided by total sales gives us our net profit percentage. So again, it's the amount of revenue left after paying costs and expenses from gross profit. So a restaurant, again, is a business that's open to the public that sells food and beverage with the sole purpose of making a profit. So what is profit? Well, it's a financial gain, or the difference between the amount earned and the amount spent. Taking in more sales than the cost of making those sales. Those are all ways of explaining profit. Now, while every food service operation is unique, these percentages here on the screen provide a general guideline that will be helpful in evaluating the opportunity of sales. Food service operations that have percentages that fall within these ranges have a pretty good chance of succeeding. Now, of course, it's good to have a business plan and check these things in advance on paper before you build everything and lay out all this money and then find out your numbers are off. That's why it's good for help for forecasting. Now, a commercial food service operation needs to make a profit to survive and keep its doors open. So they're going to run anywhere between 0 and 10%. You really like to be within 5 to 10%, as it says down here. That's what you're looking for. You don't want it to be too big. You don't want to make a 20% profit because, again, this is what you're taxed on. So your financial advisor would probably tell you to make an investment somewhere to keep that number in this range. So profit, remember, is needed to pay off loans, as debt, to grow, to expand, to provide a return on investment, and to pay your taxes. Again, so you don't want to have too much, but you need to have some in there for your profit. So profit versus loss, putting it in a different way of saying it, is profit is sales that are greater than your expenses, whereas a loss is your expenses are greater than your sales. And if you're right in the middle, that would be break even, where you don't have profit and you don't have a loss. It's called your break even point. Now, as already mentioned, the income statement is a financial statement that identifies whether or not a business has made a profit. It's a valuable tool. It helps businesses to identify how well sales are being generated, how well costs are being controlled. And there's a direct relationship between sales, expenses, and profits. So having knowledge of this information, or even your break-even point, can assist management in proactively managing their sales and their expenses. So another review, let's follow the path of a dollar as it comes into an establishment, just to see how small the profit margins, the small margins that we work on, and how easy it is to lose money in this business. Okay, using those percentages we just talked about. So here are some typical average expenses or percentages for a typical restaurant. Food cost, payroll, utilities. So those are all, generally somewhere in there. They could be, a couple points higher or lower on either side, but that's generally what you're looking for. Which means that 91 cents out of every dollar brought in as sales is going to go towards these costs and these expenses. And that means you have about 9 cents left over. 9 cents. It's not a lot. For every dollar that comes in, 9 cents will be left over. But what if you had to replace some small wares? Things get lost, plates break, things like that. That could be 1%. What if your linen, it gets dirty, you can no longer wash it, you got to replace it? That could be another 1%. So take 2% more now. This means that 93 cents of every dollar is gone, leaving only 7 cents for profit out of every dollar of sales that's brought in. Now, 7%, as we saw earlier, is okay. It fits right in between that 5 and 10% profit that we're looking for. So it's still pretty respectable. But however, that doesn't leave a lot of room for emergencies. What would happen if these numbers unexpectedly changed? What would happen if our food costs went up? Instead of 35, it's now 38. Prices rose. There was a drought somewhere. That means profit on the bottom line would shrink. Now from 7% to 4%. It means out of every dollar that comes in, we made 4 cents. Now what if labor went up at the same time? Minimum wage went up, or you had to give out raises. Now what if it went up to 35? Well, if you remember our first number, that was 30. That's another nickel. You only had a 4%, 4-cent profit. Now your expenses would exceed your income and you'd be operating at a loss. You need 101% in costs against that 100% income. So see, you think you're doing well, and it's just those little small things. You can't even control them, and then it could actually make you go into a loss. So that's something we have to watch out for. And then with lack of cost controls, working on those small margins, how do we buy new equipment? How do we give employees raises? How do we fix something that's broken? How do we redecorate, buy new china, new interior after the stuff starts to get a little bit old? We need that extra money, that profit, to then invest back into our business. So we need to make sure we're making some of that. And no profit, we can't reinvest in the business and do these type of things on the screen. And if we continue on the path of operating at a loss over time, we would most likely fall into the very high percentage of food service operators that go out of business every year. And that is not good. So as you can see, the restaurant business operates on such small margins that we really have to watch our numbers all the time and have controls in place to make our business a success. In order to maximize our profitability, we need to identify areas where our restaurant can improve. Because just one little percentage point, increased is going to hurt us, but it also can help us. 1 percentage point drop in the cost of goods, or a drop in payroll, or a drop in operating expenses will have the opposite effect. Will result in an additional percentage point to our bottom line, bringing us into profitability. So that's just those little teeny things that management can implement or do or control that can be the difference between being at a profit, being at a loss, or breaking even. Now you can analyze expenses in a different way. Businesses can analyze costs by using categories other than food, beverage, labor, and overhead. Costs can also be analyzed based on, management's ability to control them. We can call them controllable costs and non-controllable costs. It can also, in the relation to sales, so we can have fixed costs, variable costs, and semi-variable costs. So let's be more specific here. Controllable cost is a cost that management can affect by implementing a control tool or procedure that allows a reduction of waste or a cost maintenance. This would be food, beverage, wages, utilities, supplies. You can control those. So management wants to spend their time working on these specific areas, right? You can control food costs by using proper purchasing techniques to get the best prices. Or you can use portion control tools in the kitchen to reduce waste, scales and dishers and ladles. You can control wages by properly scheduling employees, thus reducing that cost. So management can have an effect on it, so you spend your time on controllable costs, not on non-controllable costs, which is something that cannot be controlled by management. Non-controllable costs, once decided, can't really be controlled. They can't really be changed. And that would be salaries, mortgages, rent, insurance. Think about a salary. You can't tell your chef, I'm going to pay you $1,000 a month. And then after 3 months in, go, we're not doing so well. How about I'm just going to give you $750 this week or $500 this week. It's not something you can control. It's already set. Or you can't, tell the bank or I'm only going to pay this much in mortgage this week or this month. It's a non-controllable. Once it's set in stone, you sign a 99-year lease, you're obligated. So you can't control those. Don't spend your time worrying about those. Worry about the things you can control. And looking at variable, fixed, and semi-variable, these are relationship to sales. A variable expense is a cost that fluctuates direct relation to sales. So the cost of food, for example, which is food costs, the cost of beverage, which is beverage costs, are really the true two variables. If you have an order for a steak, you got to buy a steak. If you have a cup of coffee that's ordered, you got to have a cup of coffee. So those are variable, direct relation to sales. Whereas fixed, a cost that does not fluctuate in direct relation to sales. These fit the criteria of non-controllable costs. Same thing we talked about earlier. Rent and mortgage are an example. Doesn't matter if you do $100 in sales or $1 million in sales, your rent stays the same. It's fixed, right? A salaried employee, unless they're working on some kind of bonus program. Once they get $1,000 a week, whether you do 10 customers or 500 customers, it's the same salary. It's a fixed cost. Now, semi-variable is a little harder, a little bit more confusion sometimes. It does fluctuate as sales fluctuate, but only in a certain ratio, a maximum or minimum level. So, for example, as sales rise, you may need more staff. You have one customer, you have to put on a waiter or waitress. You have two customers, you don't have to put on another one. Three, you don't have to put on another one. But at some point, let's say 25 customers, you have to put on another wait staff person, and that incurs another expense. So it does vary with sales, but not directly. It's semi-variable. Now, prime costs. As you can now see, food and beverage costs coupled with labor costs consume the most of our total sales. As we saw, typically 55 to 75%. The combined total of these two cost categories referred to as a restaurant's prime costs. So total cost of sales and total labor is our prime costs. It's where the battle of the restaurant's profitability is waged, because these are the two big ones that eat up everything. So that's what we really want to watch. Now, it's not simply because they represent the largest percentage of our total expenses, that's 70%, but it's because we have the ability to control them. They're controllable. Therefore, prime cost is critical for you as a manager to watch it and control it, since these costs directly relate to producing sales. As sales rise, more prime cost dollars will be spent. You need to buy more food, you need to put more people on, right? More hours to produce those sales. However, you may have to pay more, but the percentages should stay the same. Your labor cost should still be 30%. Your food cost should still be 32%, or whatever it is. You're bringing in more sales, but it's costing you the same ratio to get those sales in your costs. So therefore, because of their importance, they must be the focus of an operator's analysis. When you see a prime cost percentage exceed 70%, that should be a red flag, because it's cutting into that 30% that's left over, to pay for our expenses and hopefully give us some profit. So watch the prime costs. And that, my friends, is the end. I hope you now have a better understanding of the income statement or the profit and loss statement. And please tune into my second video, which is going to be on understanding the income statement, where I actually demonstrate the math and the calculations involved and show how it can be used as a forecasting tool as well to predict future profits and expenses. Until then, thanks for watching, and please hit the like button below, subscribe if you haven't already, and share this video if it's appropriate with some people that you might think would be interested in it. All right, thanks again. Bye-bye for now.